Today, we're diving into an exciting topic that's gaining traction in the investing world: how cryptocurrencies can diversify your stock portfolio. Whether you're a seasoned investor or just starting out, this video will provide valuable insights into how you can strengthen your portfolio by incorporating cryptocurrencies. Let's get started. When it comes to investing, diversification is a fundamental principle that helps mitigate risk and enhance returns. Diversification involves spreading your investments across different asset classes, industries, and geographic locations to reduce the impact of any single investment's poor performance on your overall portfolio. Traditionally, this has meant a mix of stocks, bonds, and maybe some real estate or commodities. But with the advent of digital currencies, a new and exciting asset class has emerged: cryptocurrencies. So what exactly are cryptocurrencies? Cryptocurrencies are digital or virtual currencies that use cryptography for security. Unlike traditional currencies, they are typically decentralized and operate on blockchain technology, a distributed ledger enforced by a network of computers. Bitcoin, created in 2009, was the first cryptocurrency and remains the most well-known and valuable. Since then, thousands of alternative cryptocurrencies have been developed, including Ethereum, Ripple, Litecoin, and many others. Now, you might be wondering, why should I add cryptocurrencies to my portfolio? Let's break down the benefits. First and foremost, cryptocurrencies offer a new dimension of diversification. Traditional assets like stocks and bonds are often influenced by similar economic factors, such as interest rates, inflation, and corporate earnings. Cryptocurrencies, however, operate in a relatively independent market, driven by different factors such as technological advancements, regulatory developments, and market sentiment. This means that the price movements of cryptocurrencies can be uncorrelated, with those of traditional assets providing an additional layer of diversification. For example, during the COVID-19 pandemic, global stock markets experienced significant volatility. While many stocks plummeted, Bitcoin and other cryptocurrencies saw a surge in interest and price. By including cryptocurrencies in your portfolio, you can potentially reduce the overall risk and volatility, as the performance of your investments won't be entirely dependent on the stock market. Another benefit is the potential for higher returns. Cryptocurrencies, while highly volatile, have shown remarkable growth over the past decade. Bitcoin, for instance, has gone from being worth just a few cents to tens of thousands of dollars. While past performance is not indicative of future results, the potential for significant returns makes cryptocurrencies an attractive addition to a diversified portfolio. Additionally, the adoption of blockchain technology and cryptocurrencies by major institutions and corporations suggests that this asset class is becoming more mainstream. Companies like Tesla, Square, and PayPal have all invested in Bitcoin, signaling growing acceptance and confidence in digital currencies. This institutional interest can provide a degree of stability and legitimacy to the cryptocurrency market, potentially leading to more growth and opportunities for investors. Now that we've discussed the benefits, let's talk about how you can integrate cryptocurrencies into your stock portfolio. Firstly, it's essential to do your research. Cryptocurrencies are a relatively new and rapidly evolving asset class, and it's crucial to understand what you're investing in. Take the time to learn about different cryptocurrencies, their use cases, the technology behind them, and the teams leading their development. Websites like CoinMarketCap and CoinGecko provide valuable information and resources to help you make informed decisions. Once you've done your research, consider starting small. Given the volatility and risk associated with cryptocurrencies, it's wise to allocate a small percentage of your portfolio to them, typically between 1% and 5%. This way, you can gain exposure to the potential upside without taking on excessive risk. As you become more comfortable and knowledgeable, you can gradually increase your allocation. There are several ways to invest in cryptocurrencies. The most direct method is to buy and hold digital currencies through a cryptocurrency exchange, such as Coinbase, Binance, or Kraken. These platforms allow you to purchase, sell, and store a variety of cryptocurrencies. When choosing an exchange, ensure it has a good reputation, robust security measures, and user-friendly features. If you prefer a more hands-off approach, consider investing in cryptocurrency-focused funds or exchange-traded funds, ETFs. These investment vehicles provide exposure to a diversified portfolio of cryptocurrencies, managed by professional fund managers. Some popular options include the Grayscale Bitcoin Trust, GBTC, and the Bitwise 10 Crypto Index Fund. Another option is to invest in companies that are involved in the cryptocurrency and blockchain space. For example, you could invest in companies that mine cryptocurrencies, develop blockchain technology, or provide cryptocurrency-related services. This indirect approach allows you to benefit from the growth of the cryptocurrency market without directly owning digital currencies. As you integrate cryptocurrencies into your portfolio, it's crucial to monitor and manage your investments actively. cryptocurrencies can be highly volatile and their prices can change rapidly. Keep track of market trends, news, and regulatory developments that could impact the value of your investments. Regularly review and rebalance your portfolio to ensure it aligns with your risk tolerance and investment goals. One of the keys to successful investing is understanding and managing risk. While cryptocurrencies offer significant potential for returns, they also come with their own set of risks. For example, the regulatory environment for cryptocurrencies is still evolving, and changes in government policies could impact their value. Additionally, the security of digital assets is a concern, as cyber attacks and hacking incidents have occurred in the past. To mitigate these risks, consider diversifying within the cryptocurrency asset class itself. Instead of investing solely in Bitcoin, spread your investments across multiple cryptocurrencies with different use cases and market dynamics. This way, if one cryptocurrency underperforms, the impact on your overall portfolio will be minimized. Another important aspect of risk management is securing your digital assets. Ensure that you use reputable exchanges with strong security measures, and consider using hardware wallets to store your cryptocurrencies offline. This adds an extra layer of protection against hacking and theft. Let's also talk about the tax implications of investing in cryptocurrencies. In many countries, cryptocurrencies are considered taxable assets, and any gains or losses from their sale are subject to capital gains tax. Keep detailed records of your transactions, including the purchase price, sale price, and dates of each transaction. Consult with a tax professional to understand the specific tax regulations in your country and ensure you comply with all reporting requirements. By now, you might be wondering about some real-world examples of diversified portfolios that include both stocks and cryptocurrencies. Let's take a look at a hypothetical example. Imagine an investor named Sarah. She has a diversified portfolio consisting of 60% stocks, 30% bonds, and 10% real estate. To add an additional layer of diversification, Sarah decides to allocate 5% of her portfolio to cryptocurrencies. She invests in a mix of Bitcoin, Ethereum, and a few other promising altcoins. Over time, she monitors her investments, rebalances her portfolio as needed, and adjusts her allocation based on her risk tolerance and market conditions. By including cryptocurrencies in her portfolio, Sarah benefits from the potential for higher returns and reduced correlation with traditional assets. This diversified approach helps her manage risk and enhance her overall investment performance. In addition to adding cryptocurrencies to your portfolio, it's important to stay updated on the latest trends and developments in the cryptocurrency market. The crypto space is constantly evolving with new projects, technologies, and regulatory changes emerging regularly. By staying informed, you can make more strategic decisions and capitalize on new opportunities. One way to stay updated is by following reputable news sources and industry experts. Websites like CoinDesk, Cointelegraph, and CryptoSlate provide comprehensive coverage of the latest news, analysis, and market trends. Additionally, consider joining cryptocurrency communities on social media platforms like Twitter, Reddit, and Telegram. Engaging with these communities can provide valuable insights and help you stay ahead of the curve. Another crucial aspect of investing in cryptocurrencies is understanding the technology behind them. Blockchain technology, which underpins most cryptocurrencies, is a revolutionary innovation with far-reaching implications. By understanding how blockchain works and its potential applications, you can make more informed investment decisions. Blockchain is essentially a decentralized and immutable ledger that records transactions across a network of computers. Each transaction is verified by multiple participants, ensuring transparency and security. This technology has the potential to disrupt various industries, from finance and supply chain management to healthcare and real estate. Many cryptocurrencies have unique features and use cases that differentiate them from traditional assets. For example, Ethereum is not just a digital currency, but also a platform for decentralized applications, dApps, and smart contracts. Smart contracts are self-executing contracts with the terms of the agreement directly written into code. They enable automated and trustless transactions, eliminating the need for intermediaries. By exploring and understanding these unique features, you can identify promising projects and investment opportunities. Additionally, consider diversifying your cryptocurrency holdings based on different use cases and technologies. This approach can further enhance the diversification and potential returns of your portfolio. Let's talk about some strategies for managing volatility in the cryptocurrency market. Cryptocurrencies are known for their price swings, which can be both an opportunity and a challenge for investors. Here are a few strategies to help you navigate this volatility. 1. Dollar cost averaging, DCA. DCA involves investing a fixed amount of money at regular intervals, regardless of the asset's price. This strategy helps mitigate the impact of market volatility and reduces the risk of making poorly timed investments. By consistently investing over time, you can average out the purchase price of your assets. 2. Setting stop-loss orders. A stop-loss order is an automatic order to sell an asset when its price falls to a certain level. This strategy helps limit potential losses by selling an asset before its price declines further. Setting stop-loss orders can provide a safety net during periods of high volatility. 1. Taking profits. Regularly taking profits by selling a portion of your holdings when they reach a certain price level can help lock in gains and reduce exposure to potential downturns. This strategy allows you to capitalize on price increases while managing risk. 2. Staying informed. As mentioned earlier, staying updated on market trends, news, and developments is crucial for navigating the volatile cryptocurrency market. By being informed, you can make timely and strategic decisions to protect your investments. In addition to these strategies, maintaining a long-term perspective is essential. While short-term price fluctuations can be stressful, focusing on the long-term potential of cryptocurrencies can help you stay resilient during market downturns. Remember that the cryptocurrency market is still relatively young, and its long-term growth prospects remain promising. Finally, let's address the psychological aspect of investing in cryptocurrencies. The volatility and hype surrounding digital currencies can evoke strong emotions, from fear and anxiety to excitement and greed. Managing these emotions is crucial for making rational investment decisions. Here are a few tips for maintaining a healthy mindset while investing in cryptocurrencies. 1. Set clear goals. Define your investment goals and time horizon. Are you looking for short-term gains or are you investing for the long haul? Having clear goals can help you stay focused and avoid impulsive decisions. 2. Stick to your strategy. Develop a well-thought-out investment strategy and stick to it. Avoid making decisions based on market noise or FOMO, fear of missing out. Trust your research and strategy. 3. Stay patient. Investing in cryptocurrencies can be a roller coaster ride. Stay patient and avoid reacting to short-term price movements. Focus on the long-term potential of your investments. 4. Seek support. Engage with supportive communities and fellow investors. Sharing experiences and insights can provide valuable perspectives and help you stay grounded. In conclusion, incorporating cryptocurrencies into your stock portfolio can provide significant benefits in terms of diversification, potential returns, and risk management. By understanding the unique characteristics of cryptocurrencies and taking a thoughtful, informed approach to investing, you can strengthen your portfolio and position yourself for long-term success. Remember, the key to successful investing is not to follow the latest trends blindly, but to make informed decisions based on thorough research and a clear understanding of your financial goals. Cryptocurrencies offer an exciting opportunity, but like any investment, they come with risks. By starting small, diversifying your investments, and staying informed, you can navigate the cryptocurrency market with confidence. Thank you for watching. If you found this video helpful, please give it a thumbs up and subscribe to our channel for more investment tips and insights. Let us know in the comments if you have any questions or if there's a specific topic you'd like us to cover in future videos. Until next time, happy investing!